Now, if you interact with the bill introduces ministerial oversight that conflicts with the Bank of Uganda's exclusive mandate. And then the Financial Institutions Act 2004, the Prudential Supervision of Fit and Proper Vetting, clause number 14 creates a dual licensing. It also introduces overlapping suitability in clause number 16. And in the National Payment Systems Act 2020, the oversight of cross-border transfers and payments providers is a core function and mandate of the central bank. But what this bill is now proposing that under clause 25, it imposes gatekeeping duties and a 4 billion civil penalty on the providers. And then the Anti-Money Laundering Act, the source of funds and violations reporting are all covered under the Financial Intelligence Authority. But clause number 21 creates a parallel reporting channel, public inspection of declaration, which violates the banking secrecy. And then the other one is to do with the Political Parties and Organizations Act, which restricts contribution from foreign sources to political parties to 20,000 currency points within the period of 12 months, and so it also prohibits political parties from demanding equivalent of 200,000 currency points. So we are seeing that the interaction with the proposed bill is that Section 13 has similar restrictions as introduced in the proposed bill, which are only limited to political parties. Now, Chair, let me go to the most important aspect of our presentation. That is, what are the comprehensive assessments of this bill? Chairman, let me be very clear from the outset. This bill is about cross-border payments. And cross-border payments is about the balance of payments, because the balance of payments is a comprehensive record of all economic transactions between a country's residents and the rest of the world over a given period of time. It tracks the inflows and outflows of money from trade in goods, services, and financial assets. The balance of payments is divided into current account balance and the financial account, and of course the capital account. Now, what is the case of Uganda? The case of Uganda is that the current account balance has always been in the negative because our imports are far much greater than exports. So how do we close this? Is through financial flows. Financial flows into the financial account. And where these financial flows exceed the deficit in the current account, that's how we build reserves. Now, what is this bill doing? This bill is bringing restrictions into cross-border transactions, meaning that it is bringing restrictions on the inflows to this country. And we run a risk of reducing substantially the inflows into Uganda. And if we reduce these inflows into Uganda, it means that our current account is even going to widen. And with the restrictions, there will be limited inflows in the financial account, which is going to make it very difficult for us to finance the widening current account balance. So how then does the balance of payments balance? We are going to have a substantial depreciation of the currency, because you need to make imports more expensive in order to equate imports to exports. So this is the main risk of this bill. And also, it means that our capacity to build reserves, because now the flows in the financial account are reducing, we won't have any excess of financial flows in the financial account over the current account balance to build reserves. And Chairman, a country without reserves is not sovereign. So, the most important thing is, how do we deal with this? If you look at, for example, what is being proposed, the potential of this bill to destabilize Uganda's balance of payments is our primary concern as a central bank, because it affects cross-border flows. For example, last financial year, the overall balance of payment surplus was 1.5 billion, meaning that the financial inflows in the financial account were in excess of the deficit in the current account balance by 1.5 billion. And that's how we were able to increase our reserve coverage by 1.5. Today, as we talk, our reserves are close to $6 billion. Why? Because these inflows have been coming in. The moment you tamper with these inflows here, we risk running down our reserves. And that is economic disaster for a country. So, these inflows were driven by foreign direct investment of 3.4 billion, portfolio investments of 2.1 billion. Remittances, we are now requiring that remittances, if there's a Ugandan in the diaspora, he's a foreigner by the definition of this bill. And anybody who receives these remittances in excess of 400 million is an agent of a foreigner. He has to be registered by the Minister of Internal Affairs. Honorable members of Parliament, for remittances that are sustaining the livelihoods of Ugandans, we are likely to see even a reduction in the remittances. I don't know what the diaspora people told you, but this is likely to come down. Last year we got remittances of 1.5 billion. And so it means that we are going to have pressure on our currency. And then the most striking thing also is, if you look at our securities market, government of Uganda is undertaking significant borrowing to finance its budget. And if you look at the holding of government of Uganda securities by non-residents, by these foreigners, they are holding to close to about $3 billion, which is about 12% of the securities that have been issued are held by this. And going by the definition in this bill, where ministerial approval for the threshold is acting as a capital control, experience in other jurisdictions shows that it leads to immediate exit of the offshore investors. And when they exit, it means that we cannot fully finance our deficit through borrowing. And if we're going to finance, it's going to be through very high interest rates. And as they exit, it will have impact on our currency. And then the other issue is clause number 13 about economic sabotage, that at the publication or anything that causes the weakening of a system is qualified as economic sabotage. Now, Uganda's debt servicing is currently about 50% of government revenue. By criminalizing economic research that identifies fiscal instability, as in clause number 13, the bill destroys what we call price discovery. Because if I'm an investor, I need to look at all the information about an economy, then I price based on that information. So when I don't have that information, because we don't have, the bill has said don't publish anything that weakens the system. What do I do if I'm an investor? I'm going to put what I call uncertainty premium, all right? So that if I had discounted for the fiscal instability or because of the high fiscal deficit into my pricing initially, now I don't have that information. I'm going to put uncertainty premium. So if I was bidding for a 25-year bond at 17%, I'm going to end up bidding at 20%, just in case I've got it wrong. Why? Because I don't have information. Markets rely on information, a wide array of information to do their pricing. So clause number 13 in our view is going to distort price discovery. And then also, when we publish a report about maybe inflation is projected to rise or the currency may depreciate, so we need to tighten monetary policy to do that. Now, if tightening of monetary policy leads to lower credit growth and the economy weakens, will I be charged with economic sabotage? Then the other issue is financial sector, de-risking and operational paralysis. The banking industry faces a systemic threat from financial de-risking and regulatory overlap. The corresponding banking that facilitates trade and clearing transactions. These banks operate on a zero failure compliance environment. If routine operations like capital injections or trade financing clearing require ministerial approval, international banks are likely to terminate relationships, therefore isolating Uganda from the global payment system. And then the recruitment deterrent. Clause number 23, subsection 3, with its liabilities, and clause number 16 of intrusive suitability inquiries, including fiscal health, may deter qualified professionals from participating in the governance of the Ugandan financial institutions. Colleagues, honorable members of parliament, I want to be very frank here. When we are looking for board of directors for financial institutions, this is a skill that is still very scarce in Uganda. Now, most of these financial institutions have ended up getting skills from abroad into their governance structures. Now, with these very, very intrusive suitability requirements, it will be difficult for these supervising institutions to get these skills. And therefore, we are likely to end up with weak governance in the financial institution. And then procedural disruptions. There's a lack of the commencement clause. So when this bill, if passed, when does it become operational? There's no transition time given, but that's another matter. And then in terms of the capital requirements, you all know that Tier 1 banks require 150 billion, Tier 2 require 10 billion, Tier 3, 4 require 1.5. Now, this cap would severely restrict capital injections, intercompany shareholding loans, and correspondent banking, all of which are essential for liquidity management and regulatory compliance. And then the policy framework, and this is, honorable members of parliament, this is a very, very important point. Since 1990s, the Uganda's successful and sustained economic recovery has been built on policy predictability. What this bill is introducing, it is introducing what we call time and policy inconsistency. That is going to threaten the tenfold growth that the government of Uganda is aspiring. If you look at our investment levels that are required, they are far much lower than the savings we have. So we require foreign capital to fill up this gap. Now, if we are going to grow the economy to $500 million by 2040, we require annual FDI to rise to about $50 billion. And we require domestic savings to strike to 40% of GDP. Now, the administrative restrictions that this bill is creating is not going to make this possible. So what happens to our tenfold growth? Because this is going to slow it all down. So we need to look at how is it affecting other policy objectives. And then, because the bill is so restrictive in regulation, is likely to drive actors into informality. We are going to have informal channels again coming back. Things like the Hawala systems or the unregulated financial instruments, which is eroding the tax base and undermining the bill stated goal of transparency. Honorable members of parliament, it was only in 2024 that Uganda came out of the Financial Action Task Force grey list. Why? Transparency was one of the key issues. So we are trying here to increase transparency as much as possible. Now, if the bill is going to create informality and therefore raising transparency, what are the chances that we might get back into this? It's something for each of us to ask ourselves. And then contract frustration and legal uncertainty. Financial institutions by their very nature deal with multi-year loans multi-year transactions. So if the bill is, if the agent of a foreigner requires to be renewed after every 2 years, and the bank here is an agent of a foreigner, you have this multi-year loans that you have gone into. Suppose, God forbid, the Minister of Internal Affairs doesn't renew the license for you being an agent of a foreigner. What happens to your multi-year contracts? So I think there are certain challenges in there. So this risks sovereign borrowing disruptions, breach of contracts lawsuits, loss of investor confidence due to restrictive application, and then alignment with other existing frameworks. Again, channel all oversight through the Financial Intelligence Authority. So, and we also request that maybe you clarify the bill's relationship with the existing financial laws. How do they relate with the FIA, AMLA, NPS Act, PPO, to avoid redundant or conflicting reporting lines? So in conclusion, Chairman, true national sovereignty is built on economic strength and financial independence. While the goal of protecting national interests is legitimate, the protection of the Sovereign Bill 2026 as currently drafted risks reversing 3 decades of successful financial development through liberalization that has sustained economic growth. By adopting these technical refinements, we believe that Parliament can safeguard the nation without compromising the world-class financial architecture essential for Uganda's journey to achieve the 500 billion economy. I submit.
Thank you, Governor Ego.
Procedure, Chair.
Procedure.
Chair, with your permission.
Yes.
Since the governor's time is still has some 5 minutes, could we allow Professor Nwagaba to make some supplements?
If he has. Are you, if he has anything useful to add? Are you not considering this jointly done? I'm sure these are your students. We take it that they want to listen to the professor, but I take it that this is a joint statement. Thank you, and very comprehensive. He has commented. I think, honorable colleagues, let's give a chance to Financial Intelligence Authority to also make a presentation. Now, if a point has really been canvassed very well by the governor, then you don't need to belabor. If you think, especially with regard to your mandate, highlight, no problem about it. But as for anything that you think the governor has ably explained, you can jump. Over to you, Financial Intelligence Authority. Yeah.
Thank you, Chair.
And what have you? Also, Honorable Members of Parliament, we are now in a digital economy where real-time transactions take place. Now, we require the Minister of Internal Affairs to approve any payments that are going to be made by agents of foreigners to foreigners. In a real-time payment, straight-through processing, at what point does the Minister of Internal Affairs come in? When we have digital. Unless we're going to say that let's stop digital and go back to manual. Honorable Members of Parliament, it's your judgment. Now, we think that technical incompatibility, the manual ministerial reporting and approval processes are technically incompatible with the velocity of digital finance. Now, then there are other things like the constitutional order, socioeconomic scale. Parliamentary records indicate that approximately 5 trillion shillings in external funding and between 20,000 and 50,000 Ugandan jobs are tied to organizations, and these are currently at risk. Now, also the international standings, like the IMF Article 8 of free movement of financial flows, then the East African Community Common Market Protocol on free movement of capital. All this is going to be affected. What happens to these international obligations? And then the risk-based approach that is required for Uganda to stay on the Financial Action Task Force grey list. What happens if we are going to have blanket regulations instead of the risk-based approach that is recommended? So Uganda's obligations set out in various international conventions and treaties with bodies including the IMF, World Bank, IADB, IFC, etc., whose articles of agreement, including those relating to privileges and immunities, are going to be affected by this bill. So what I was, in conclusion, Honorable Chairman, what are the strategic recommendations for the legislative requirement? To ensure that the bill is consistent with Uganda's long-term stability, the Bank of Uganda recommends the following refinements. 1. Affirmation of regulatory primacy. Confirm that the Bank of Uganda retains exclusive authority for the regulation and supervision of the financial sector, supported by Financial Intelligence Authority for anti-money laundering and combating financing of terrorism matters. These institutions already are operating effectively under well-established statutory mandates, and reaffirming their primacy would preserve the regulatory coherence and accountability, avoid dual licensing and inspection, maintain operational independence, and ensure international compliance. And then also retain government oversight on foreign funding for political parties under the Political Parties Organization Act as amended, which already excludes remittances, legitimate financial transactions, and other cross-border transactions between Ugandan citizens and regulated entities. Then the second recommendation that we are making is the explicit exemption for regulated entities. Categorically exclude financial institutions licensed under the Financial Institutions Act, the National Payment Systems Act, supervised by the Capital Markets Authority, from definition of agent of a foreigner. Such institutions are already subject to rigorous prudential oversight and governance requirements, making additional classification unnecessary and counterproductive. This aligns with the Political Parties Organization Act. And then the revision of the funding thresholds. Maybe replace approval threshold with disclosure only requirement for transactions undertaken in a normal course of banking. And then also exempt interbank transactions, shareholding arrangements, credit lines, and FDI, touching supervised financial institutions as exempted under the Political Parties Organization Act. And let's narrow the definition of economic sabotage. So redraft clause 13 to exclude legitimate economic research, remove various criminality liabilities for directors as in clause 23 subsection 3, introduce defense of good faith, exercise of mandate, compulsion of statute by...
Thank you very much, Chair. From the moment the governor started his submission, I have been grappling in my mind with what's going on in this country. What we are doing today, Chair, is what should have been done by government. Talking to the central bank, talking to FIA, talking to Makerere universities, talking to banks, talking to literally people who should be the stakeholder. But from all of them, as they have appeared here, they seem to be so confused about who actually brought this sort of legislation here. That's the ugly position government has put us into it. Because I'll give you an example, Chair. Clause 13 of the bill, which talks about prohibition of economic sabotage. If this bill was to be passed as it is, the deputy governor would be in jail before you assumed that position of deputy governor. Professor Nwagaba, you agree with me? He would be in jail. I'm a keen observer and reader of public information, and I used to read a lot of your articles. And some of them could actually be interpreted as sabotage because they are so critical about some government policies. How on earth do you criminalize research and thinking and criticism for purposes of improvement, or abandoning a policy which is not working? If the Minister Kahindo Tafire had the courtesy maybe of talking to you, I mean Central Bank, maybe we would not be here today. You would have sorted out this sort of problem. FIA, I think you are doing a pretty bad job. Otherwise, why would we have this law if you people were doing what we mandated you to do? You remember we set you up by an act of parliament because we thought everything here which has been brought, you'd be able to handle it. Is this a confession that actually you failed in your duties, and therefore we are setting up a parallel system? And since the bill came up, have you two, either Bank of Uganda or FIA, talked to your line minister, say what is this going on? If you haven't, then you're not doing service to some of us. I think we should be doing other things. Let government come prepared after enough consultation. So the problem, Chair, is lack of consultation.
Prior.
Of course, prior. And the public should be extremely happy with us because we are doing what cabinet should have done or the minister should have done. Having said that, not to be critical, let us look at other jurisdictions that have had what we call over-regulation. I don't know, and this, I'm talking to the central bank. A country like Ethiopia, just look at the financial regulations they have had over years, the financial regimes they have had over years, and whether they have since then moved away from that restrictive financial regulation to a more liberal one. Reason is for purposes of attracting investment. We need to have regulations in place that makes business easy and attractive, somebody with money. But if you have too much regulation, I can tell you, no serious person with serious money will bring his money here. That you need to put in $5–10 million, then you must go to Ginger Road. There is an office there, Ginger Road, you call the Minister of Internal Affairs. And you start lining up looking for a certificate from the minister. and the chair, he raises a very important point.
He did.
Because one, cross-border transactions now are so digital, even internal transactions. Tell me how we shall be doing this. This law envisages paper certificates. People to go to the minister's office and sit there, say, you know, I'm remitting $100, or somebody is going to send me $100. So there is a big, big problem, but as you go back, I think you need to engage your minister. You should have raised this issue in the cabinet. Other than you people coming here to the public, and now you can see the sort of conversation we are having. Like government institutions seem not to agree. And that's quite ugly. Government institutions should be agreeing. So by the time you bring a bill to us in Parliament, you should have agreed as government departments, agencies. There must have been enough consultation. Chair, I think they have
Thank
said
you.
it all.
Thank you, Honorable Katuntu. Yes, Honorable Gilbert Olanya.
Thank you, Chairman. Mr. Chairman, I would like to appreciate the Governor of Bank of Uganda